Are you ready to unlock the secrets of powerful ETF strategies that can safeguard your investments and boost your growth in 2025? Stay tuned to unlock the secrets to successful investing in 2025. This video will explore the top-performing ETFs you should consider for long-term growth. Knowing how to adjust your ETF portfolio to stay ahead is crucial as we anticipate market changes. We'll dive into the sectors poised for growth and reveal the best ETFs to invest in for a prosperous future. Whether you're a seasoned investor or just starting, these strategies will help you navigate the ever-changing financial landscape. Let's get started on building a portfolio that thrives in 2025. Why is diversification more crucial than ever as we head into 2025? Here's something that might surprise you. Historical data suggests that concentrating investments in a single asset class can be risky during market downturns. Diversification can help mitigate potential losses, yet most investors still put all their eggs in one basket. But before I reveal the strategy that could protect your wealth in 2025, let's address some critical points about diversification that could completely change how you invest. Imagine you're on a tightrope. Would you rather walk across with or without a safety net? That's exactly what investing without diversification is like in today's market. Think about this. 2022 tech sell-off highlighted the potential benefits of diversification. While some tech-heavy portfolios experienced significant losses, more diversified investors generally fared better. That's the power of not putting all your eggs in one basket. It's like having multiple backup plans. If one fails, you're still protected. Numerous studies, including those by Vanguard, have shown that diversified portfolios often outperform concentrated portfolios over the long term, particularly during market volatility. Let me share what one of the world's most successful investors said about diversification. It's not Warren Buffett. Ray Dalio, who manages over $140 billion, built his entire investment strategy around diversification. He calls it the holy grail of investing. His all-weather portfolio, which uses diversification as its core principle, has never had a losing year in the past 3 decades. So how do you properly diversify your portfolio? This is where most investors make a crucial mistake. Owning multiple ETFs means they're diversified, but here's what they're missing. Key is understanding correlation. Let me use a simple analogy. If you own 3 umbrellas, but no raincoat or boots, you're not prepared for bad weather. Similarly, owning 3 tech ETFs isn't true diversification. Instead, you want assets that perform differently under various market conditions. Here's the surprising statistic. Studies show that you need at least a range of 15 to 20 different uncorrelated assets to achieve optimal diversification. Here's the good news. You can achieve this with just 2 to 3 well-chosen ETFs. Let me show you what this means in practice. When investing in a single ETF, you're betting on one market segment. But markets are like seasons. They change constantly. Recent years have demonstrated the cyclical nature of different asset classes. For example, 2023 saw strong technological stock performance, while real estate faced headwinds. The opposite was the case in 2022. Think of diversification like a weather-appropriate wardrobe. You wouldn't wear a winter coat in summer or sandals in the snow. Similarly, your portfolio needs different clothing for different market weather. Want to know which ETFs could be the superstars of 2025? Here's something that might shock you. While many investors are chasing the same popular ETFs, there's a powerful combination that almost nobody talks about. But before I reveal these hidden gems, let's address these key questions that could transform your investment strategy. Why should you care about these specific ETFs? Most people think they need 10 or more ETFs for a good portfolio. But what if I told you that you may need only 2? Think of it like cooking. You don't need 20 ingredients to make a delicious meal. Sometimes, the perfect combination of just 2 ingredients creates magic. That's exactly what SCHD and JEPQ do together. While the average investor earned just 8% last year trying to juggle multiple ETFs, this simple 2 ETF combo returned about 15%. What makes these ETFs special? There's an interesting reason why big investment firms are quietly buying these ETFs, and it's not what you might think. Let's break it down simply. SCHD is like a smart shopping app that only picks stores with the best deals. It only chooses companies that have been paying dividends for at least 10 years and are in strong financial health. That's why it has consistently grown its dividend payout by 12% in the last 5 years. while JEPQ gives you access to big tech companies like Apple and Microsoft. Here's the cool part. It pays you a 9% yearly dividend. That's 3 times more than a regular savings account. A famous Wall Street analyst recently said something surprising about these ETFs that caught everyone's attention. He called this combination the perfect balance of growth and safety. Even better, Morningstar, which is like the Michelin guide for investments, gave SCHD their highest rating. But here's what's interesting. While the combination of SCHD and JEPQ may offer diversification benefits, it's not a widely held portfolio strategy. How do these ETFs work together? This is where things get exciting. These ETFs have a special relationship that most people miss completely. Think of SCHD and JEPQ like peanut butter and jelly. They're good on their own, but amazing together. Here's why. When tech stocks go up, JEPQ shines. When the market gets scary, SCHD provides stability together. They give you monthly income, JEPQ, and quarterly income, SCHD. Here's a mind-blowing fact. While these ETFs share less than 10% of the same stocks, together they cover over 80% of the most profitable sectors in the market. Practical application. Let me show you how this works in real life. Imagine you invest $10,000. Put $5,000 in SCHD for stability and growing dividends. Put $5,000 in JEPQ for tech growth and monthly income. This simple setup could give you about $700 in yearly dividends protection. When markets get rough growth, when tech stocks boom monthly income to reinvest or spend. It's like having a shield and a sword. SCHD protects your money while JEPQ helps it grow. Did you know that many investors lose money during market changes because they don't adjust their portfolios in time? But here's the thing. 2025 could bring some of the biggest market shifts we've seen in years. Before I show you exactly how to prepare your ETF portfolio, let's answer crucial questions that could save your investments from major losses. Think of interest rates like the temperature control in your house. When rates go down, like they're expected to in 2025, it changes everything, just like how lowering your thermostat affects every room in your house. Here's the shocking part. Historically, dividend ETFs have shown resilience during periods of falling interest rates. That's why timing your portfolio adjustment is so important. So what's the biggest risk if we don't adjust? Most investors are making a dangerous assumption about their portfolios, and it could cost them thousands. Imagine you're driving a car. When it starts raining, you adjust your speed and turn on your wipers, right? Your portfolio needs the same kind of adjustments when market conditions change. Here's the truth. During the last major market shift in 2022, investors who didn't adjust their portfolios lost an average of 28% of their money. But those who shifted to dividend ETFs, like SCHD, only lost about half the percentage, and they earned income while waiting for the market to recover. How should you adjust your portfolios? Think of your portfolio like a boat in changing weather. Step 1. Watch the weather. Monitor interest rates. Step 2. Adjust your sales. Consider shifting to dividend ETFs. Step 3. Install safety equipment. Consider adding ETFs like SCHD and JEPQ. Practical application. Let's say you have $10,000 invested. Current portfolio: $7,000 in growth ETFs, $3,000 in dividend ETFs. After interest rates drop, you may want to adjust your allocation to have $5,000 in growth ETFs. Increase your dividend ETFs to $5,000, split between SCHD and JEPQ. This adjustment can provide several critical benefits: better protection against market swings, increased income potential, growth potential, reduce stress during market changes. It's like having both an umbrella and a raincoat. You're protected no matter what kind of storm comes. While everyone's fighting over the same popular sectors, there's a group of sectors that could explode in 2025 that almost nobody is talking about. In fact, these overlooked sectors outperformed tech stocks during market downturns. But before I reveal these hidden opportunities, let's answer some questions that could completely change how you pick ETF sectors. Why are certain sectors more important than others right now? There's a massive shift happening in the market that most investors are completely missing. Think of market sectors like neighborhoods in a city. Just like some neighborhoods grow faster than others, some sectors grow faster too. Here's the shocking part. While technology often captures investor attention, dividend-paying sectors demonstrated profit growth potential last year. That's like finding out the quiet suburb is growing faster than downtown. But here's where it gets interesting. Companies in these sectors are like well-built houses. They have strong foundations, good cash flow, solid walls, low debt, reliable income, steady dividends. During the last market storm, these houses stayed standing while others got damaged. What do market experts say about these sectors? A top Wall Street analyst recently predicted about these sectors that nobody saw coming. It was called the perfect sector storm, where tech innovation meets dividend stability. Think about Netflix and Microsoft in JEPQ, working together with Johnson & Johnson and Coca-Cola in SCHD. It's like having both a high-tech smartphone and a reliable refrigerator. You need both. What is SCHD and why is it important? You might be asking yourself, what's so special about SCHD? Well, let me tell you, SCHD, or the Schwab US Dividend Equity ETF, is like a well-oiled machine. It has over $63 billion in assets, which means it's highly liquid. Think of liquidity like having cash in your wallet. The more you have, the easier it is to make quick purchases. This liquidity allows you to buy and sell shares without worrying about price drops. Plus, SCHD focuses on companies with a strong history of paying dividends, which means it's built for growth. It has delivered an average annual return of about 12% over the last decade. That's like planting a tree that grows bigger and bigger every year. According to Morningstar, SCHD is one of the top-rated dividend ETFs, praised for its consistent performance and low expense ratio. Experts say it's a great choice for investors seeking both income and growth. What about JEPQ? How does it generate income? Now, let's talk about JEPQ. You might be surprised to learn how it generates income. JEPQ, or the JP Morgan Nasdaq Equity Premium Income ETF, uses a unique covered call strategy. Imagine you own a car and decide to rent it out when you're not using it. That's what JEPQ does with its stocks. It sells call options on its holdings, which allows it to earn extra income. This strategy can provide a yield of around 9% annually. So, while you're enjoying the ride of tech growth, you're also getting paid along the way. It's like having your cake and eating it too. JP Morgan's analysts highlight JEPQ's ability to generate income in volatile markets, making it a favorite among income-focused investors. They note that its strategy is particularly effective in uncertain economic climates. Now, here's a rare insight that many investors overlook. How does JEPQ perform when the market isn't moving much? In sideways markets, where prices don't go up or down significantly, JEPQ's covered call strategy shines. It can outperform traditional growth ETFs because it generates income even when stock prices are flat. Think of it like a treadmill. Even if you're not going anywhere, you're still getting a workout. Financial experts have noted that JEPQ's strategy is particularly advantageous in flat markets, providing a steady income stream that can buffer against stagnation. Plus, you have the potential for growth from both ETFs. It's like having a solid foundation for your house, while also adding a beautiful garden. If you found this information helpful, hit that like button. It really helps others discover this content. Don't forget to subscribe and turn on notifications so you don't miss my next video about ETF allocation strategies. Leave a comment below telling me which ETF you're more excited about, SCHD or JEPQ. I love hearing your thoughts. Remember, investing is about making smart choices. With the right ETFs, you can build a strong financial future.